Every time the stock market crashes in the US, headlines explode with phrases like, "Trillions of dollars wiped out in a single day." You open your portfolio, and everything is red. It feels like massive wealth has just vanished from the world. But here's the strange question almost nobody really explains clearly: where did all that money actually go? Did it disappear into thin air? Did someone secretly take it? Or is the entire idea of money being lost actually misunderstood? Because the truth is, when markets crash, money doesn't vanish. But it also doesn't stay where you think it is. Most people in the US think of the stock market like a giant bank account. You put money in, it grows, and when it falls, that money is somehow getting deleted. But that's not how it works at all. The stock market is not a storage system for money. It is a live pricing system, a place where buyers and sellers constantly decide what something is worth at that exact moment. The number you see on your screen is not stored cash. It is simply the latest price someone is willing to pay for a share. And that changes every second based on fear, confidence, news, and demand. Let's make this real. Imagine you bought a used Tesla for $40,000. A few months later, suddenly new models come out, interest rates go up, and buyers slow down. Now when you try to sell it, people only offer $32,000. Did $8,000 disappear from the car? Of course not. The car is exactly the same. What changed is only what people are willing to pay for it today. The stock market works exactly like this, but on a much larger and emotional scale. Stock prices are not fixed values. They are constantly moving reflections of human psychology. When people are confident, they bid prices up. When fear kicks in, they pull bids away, and prices drop. Think of it like Airbnb pricing during events. When demand is high, prices spike. When demand disappears, prices fall, even if the apartment itself didn't change at all. The same happens with stocks. Nothing, inside the company, is instantly destroyed just because the price moves down. So when you hear, "the market lost trillions," what does that actually mean? It does not mean trillions of dollars were physically removed from the system. It simply means this: the total value of all shares, based on the latest lower prices, is now mathematically smaller. That's it. It's a valuation change, not a cash disappearance. No central bank printed money and deleted it. No vault was emptied. It's just math based on human pricing behavior. So if nothing is actually destroyed, why does it feel so real? Because during a crash, emotions take over. People panic. Headlines amplify fear. Social media spreads uncertainty. And suddenly, everyone tries to sell at the same time. But here's the key point most beginners miss: backhand index pointing right for every seller, there is a buyer. Money is not disappearing. It is simply changing hands in real time. Think about Craigslist or Facebook Marketplace in the US. If you sell your laptop for $500, someone else pays you $500. You don't lose money into the system, it comes directly from another person. Now imagine thousands of people doing this at once, with fear in the background. That's the stock market during a crash. Money is always moving between people, not disappearing. Here's the critical part. You don't actually lose money when prices fall. You only lose money when you sell during the panic. If you own a stock at $100 and it drops to $60, that's a paper loss. It's temporary. You still own the same asset. But if you panic and sell at $60, then you lock in that loss permanently. That's when real money leaves your hands. Sometimes crashes don't just happen because of fear. They accelerate because of something called forced selling. In the US market, many hedge funds and traders borrow money to buy stocks. When prices fall too much, their lenders issue something called a margin call, basically telling them to add more cash or sell assets immediately. If they can't, their positions are automatically sold. This creates a chain reaction, forced selling, lower prices, more margin calls, even more selling. That's why crashes sometimes feel like they spiral out of control. Think of it like this. If someone buys a house using a loan and suddenly loses income, the bank might force them to sell the house to recover money. In the stock market, this happens millions of times at once during stress periods. And it amplifies the crash far beyond normal buying and selling. During extreme panic, something interesting happens: buyers step back. Everyone wants to sell, but very few want to buy. So even though value hasn't disappeared, liquidity dries up. That's when prices fall faster. Not because money is gone, but because buyers are temporarily afraid. During the 2020 crash in the US, markets dropped sharply in a very short time. News was negative, fear was high, and many investors sold at the bottom. But what happened next surprised many people. Those who stayed invested, or bought during the panic, saw one of the strongest market recoveries in history over the next few years. The money didn't disappear in 2020. It simply moved from fearful sellers to patient buyers. So here is the real truth most people never fully understand: the stock market does not destroy money. It redistributes ownership based on emotion, timing, and behavior. Prices go up and down, but money itself doesn't vanish. It just changes hands between participants. The biggest mistake most investors make is checking their portfolio every day and treating it like real cash sitting in a bank. It's not. It's a reflection of today's emotional market price. And in every crash, there are always two types of people: one group panics and sells. The other stays calm and waits. And over time, the difference between those two decisions becomes massive. So the next time you see headlines saying, "Trillions wiped out," remember this: the money didn't disappear. It simply changed hands, from the impatient to the patient, from fear to confidence, and from panic to opportunity. And that is the real story behind every market crash. If you found this helpful, subscribe to our channel for smarter investing insights.